I could have been twice as rich if I hadn't made one dumb mistake 50 years ago.
One mistake decades ago cost me half my potential wealth. Not an exaggeration, just math. Compounding amplifies your wins, but it also magnifies your errors. If you're over 50, here's a hard truth. Your biggest life moves are likely behind you. Your career path is mostly set, your risk-taking window has narrowed, and your time to recover from blunders is short. Gambling with your future now is like betting your home on a roulette spin, reckless and unnecessary. After 50, wealth isn't about genius, it's about dodging disaster. People obsess over finding the next big thing, a tech unicorn or a crypto jackpot. That's just noise. At this stage, the real game is survival. Growing up during tough economic times taught me that people don't lose everything because they lack smarts. They lose it because they borrow too much, trust the wrong people, or assume the good times are permanent. History repeats itself, only the faces change, not the mistakes. Play defense, not offense. Here's the top advice for anyone over 50. Prioritize defense. Your 20s and 30s were for bold moves. You had time to bounce back. At 50, time is not your ally. Chasing hot stocks or quick schemes to catch up often ends in ruin. I knew a sharp professional, well-educated, successful, who at 53 poured his savings into trendy tech ventures in the early 2000s. By 2005, his wealth was gutted, and he spent years regretting what could have been. Had he stuck with steady, unglamorous companies, think consumer staples or utilities, he'd have been secure. Not flashy, but safe. At this age, safe is enough. The real threat isn't missing out on gains, it's catastrophe. Losing half your savings at 60 is a different beast than at 30. You don't have decades to rebuild. Shift your mindset from outsmarting the market to avoiding stupidity. That's a full-time job. Forget chasing unicorns or being the cleverest investor. The clever ones often end up broke or burned out. Your goal is durability, having enough to outlast your mistakes. Avoid these traps. A leverage. Debt is a death sentence when time is tight. A speculation. You won't outsmart the young traders glued to their screens. A complexity. If an investment feels like a puzzle, you're likely the mark. Boring is your friend. Boring compounds. Boring keeps you solvent. The less exciting your portfolio, the more exciting your retirement can be. Aim not to go broke, not to get rich overnight. Envy. The silent wealth killer. Envy destroys more wealth than market crashes. People don't fail because they can't earn. They fail because they can't stand others earning more. It's the most pointless vice. No joy, just resentment while others enjoy their wins. It's contagious, too. A friend brags about a stock windfall, and suddenly your steady portfolio feels inadequate. That's when you make dumb moves. In the 1990s, while others chased tech bubbles, some stuck with dull businesses, insurance, retail, staples. When the dot-com crash hit, the flashy investors were wiped out, but the boring ones were still standing. I saw a retiree, comfortable with modest investments, get lured by peers' oil stock gains. He leveraged up, chased the hype, and lost everything when the market turned. His peers survived. He didn't have time to recover. At 50, envy is deadly. One jealous decision can erase years of discipline. The best investors ignore the noise, social media, news, or boastful friends. They focus on their own path. Root for other success. It costs you nothing. Being bitter at 75 over someone else's wealth is a wasted life. Your retirement doesn't care about your neighbor's portfolio. Neither should you. The cost of selling too soon. Mistakes teach more than victories. Years ago, I invested in a company that looked solid. Good numbers, decent leadership. I sold early for a quick gain, thinking I was smart. Had I held on, that stake could have transformed my wealth. Compounding punishes impatience. The error wasn't the pick, it was my lack of staying power. Most investors get this wrong. They sell winners too fast, chasing certainty, and hold losers too long, hoping for a turnaround. It's backward. Great businesses, ones with enduring demand, thrive through noise like wars or recessions. Your job isn't to predict headlines, it's to hold on to those golden geese. At 50, a premature sale can cripple your nest egg permanently. Find a reliable business, One you'd bet will still earn in 20 years, and hold tight. Excitement is a lousy strategy. Patience wins. The danger of overconfidence. The market loves to humble the cocky. I've seen it for decades. 1930s pessimists hoarding cash, missing recoveries. 1960s optimists overpaying for stocks, crushed in the 1970s. 2000s tech enthusiasts burned by bubbles. Confidence feels great, but often leads to ruin. The loudest predictors usually lose the most. Wealth comes from knowing your limits. I once knew a professional who, after reading a few articles, bet big on currency trades. His savings vanished, not because the market was unpredictable, but because he thought he could predict it. Had he admitted, "I don't know," and stuck to simple investments, he'd have been fine. At 50, overconfidence is a luxury you can't afford. You don't need to have an opinion on every trend or sector. Stick to what you understand, and say, "I don't know" to the rest. The world sells certainty, analysts, gurus, pundits, but none of them pay your bills when their predictions fail. Asking, "What if I'm wrong?" can save your future. Ownership over careerism. The biggest divide in wealth building is mindset, employees versus owners. Employees chase titles, promotions, and approval. Owners chase assets that work independently. Most people, even high earners, stay employees, polishing resumes, pleasing bosses, living for paychecks. That's a trap. Titles don't compound, ownership does. I knew lawyers earning fortunes but owning nothing durable. If they stopped working, the money stopped. By contrast, owning stakes in businesses, stocks, real estate, or small ventures creates income that doesn't need your daily grind. At 50, you can't afford to trade time for money forever. Energy fades, health wanes, and the clock runs out. Shift to ownership. It doesn't mean quitting your job. It means redirecting earnings to assets that pay you when you're not working. Buy shares in stable companies, invest in income-generating property, or build a side venture. Nobody cheers when you buy a dividend stock, but in 15 years, those checks will cheer you. Careerism fades. Ownership endures. Lessons from hard times. Economic hardship leaves scars. In the 1930s, markets crashed nearly 90%, families lost homes, and businesses vanished. People today call a 10% drop volatility. Back then, it was devastation. I saw livelihoods disappear, not from lack of brains, but from debt, blind optimism, and fragile plans. The lesson: good times aren't guaranteed. Debt makes you vulnerable. Without it, you weather storms. With it, you're the first to fall. Resilience trumps brilliance. Small, frugal businesses survived the Depression by adapting, while flashy operators collapsed. I learned to prioritize durability, owning businesses that sell essentials people buy in any economy, like food or insurance. People laughed at such boring choices, but those businesses outlasted the skeptics. At 50, you can't afford to relearn this. A single financial collapse could end your independence. Build a portfolio for survival. No debt, a safety margin, and assets that endure downturns. Assume hard times will come, because they will. History doesn't repeat exactly, but human folly does. 3 habits to win. Success boils down to subtraction. Avoid debt, drama, and dumb choices. Debt kills discipline, amplifying losses when markets turn. I saw people lose homes in the 1930s because they borrowed in good times. At 50, one bad debt can ruin you. No recovery time. Drama wastes energy. Feuds, toxic relationships, or chaos sap focus from building wealth. Smart people ruin themselves with pointless conflicts. Avoid them. Dumb choices often come from dumb influences, reckless, dishonest, or shortcut-obsessed people. Their mistakes infect you. I saw colleagues tank their careers by partnering with slick talkers promising quick riches. Choose reliable, rational allies. Fewer, better connections beat a crowd of liabilities. The power of partnership. Great partnerships amplify success. Trust, shared values, and complementary skills create efficiency most lack. A reliable partner keeps you grounded, not chasing fads. But misjudge character, and even a good deal can cost you. I've seen promising ventures fail because of dishonest or erratic partners. At 50, a bad partnership can derail decades of work. Choose those who make you sharper, not reckless. Wealth as a byproduct. Riches aren't the goal, they're the result of avoiding folly. Don't aim for brilliance, aim for consistency. Save diligently, invest simply, and ignore distractions. It's not sexy, but it works. At 50, you don't need to double your money, you need to protect it. A steady 7% return over 15 years can quadruple your wealth. That's not luck, it's math. The ultimate rule. Here's the brutal truth. If you spend more than you earn, no strategy saves you. Arithmetic doesn't care about your excuses. Overspending turns compounding against you, digging a hole no investment can fill. I've seen high earners retire broke because they couldn't resist lifestyle inflation. Meanwhile, modest savers die secure because they lived simply. At 50, the stakes are higher. Every choice shapes your independence or your dependence. The goal isn't glamour, it's dignity. Cut debt, drama, and folly. Live below your means. Invest in what lasts. Do that, and compounding will deliver. Overspend, and nothing can help. At 70, will you envy others' toys or enjoy your freedom? The choice is yours. Execution is everything.